there's going to be, when you're stuck with two trade-offs, too much inflation, or you're stuck with too much economic weakness, then you navigate for the middle, and that means something like stagflation. And so I think we're entering a period of stagflation. And I think the political and the wealth gap issues and so on create a set of circumstances that it's not easy to get out of. What you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now as inflation still remains high and it starts to pinch on both the markets and the economy. It's funny because, everybody says, okay, there'll be 7 increases or something like that, and that sounds like a lot. But you're taking interest rates up to something like 2%. And that 2%, which starts to squeeze the capital markets, starts to make it more difficult for a holder of equities, because the equity, when you raise the return on bonds and you raise the return on cash and you tighten money, then that makes other assets less attractive, such as risky assets, particularly long duration assets like tech stocks and the like. So you produce that squeeze, yes, but that's still only at 2% or a little bit over 2%, with an inflation rate which is considerably higher than that. We've had a 7% inflation rate, and we'll probably settle, it'll be a 5%-ish or something. And so you're still losing that money to inflation. People are. So what you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now as inflation still remains high and it starts to pinch on both the markets and the economy. It's like, here's the problem. If you're borrowing more money than you're lending and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off. So what can you do? Do you spend less money? The trade-off becomes more and more difficult, and that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic, spending more than they're earning, creation of a lot more debt, and a lot of other debt, which one man's debts are another man's assets, and that the holder of that assets is losing money. Imagine holding a bond now, and look at how much money is in bond funds and cash, okay? Not only in cash, you don't get any return to compensate for the interest rate, and in your bond fund, you get negative returns. And how's that feel? So are you going to continue to hold those bonds in that bond fund? It's a dynamic that they have to deal with that is really beyond their capacity to deal with it. They can't change those fundamentals. I think that most likely what we're going to have is a period of stagflation. And then you have to understand how to build a portfolio that's balanced for that kind of an environment. So there's a whole relationship between cash, bond yields, and equity returns. So every investment is an exchange of a lump sum payment for a future cash flow. And so the cost of money is a consideration based on relative to the return on money. And so when we look at that return, when we say I can hold cash or I can hold a bond, that changes the inclination to hold cash. But also, one has to look at the expected return on equities. In other words, one calculates the present value of future cash flows. You estimate what are those earnings going to be in the future and what are they worth today. And so stocks are now having expected returns, which are not very much more than bonds, which would be not very much more than cash. So that why should I own equities farther out, and have the volatility of equities. So that shift in the curve, in other words, the relationship between cash, bonds, and then the relationship between bonds and equities, and the relationship for corporations between the rates at which they borrow at and the rates at which they can earn money at, have a pervasive effect on the economy and the markets. So no, it's important to take a look at that relationship, that yield curve structure that way. But you should go beyond that and include the returns of other assets. What can you do in the way of generating returns relative to the costs of money, the relative attractiveness of those instruments? We're beginning a paradigm shift. Paradigm shift is a shift from one mindset, and positioning of that mindset to another mindset and another positioning of that. So, for example, the mindset that we were in was that you have low inflation, and when you're owning bonds and you're owning cash, or you are operating one way, and you don't worry about that, and companies don't worry about it in their inventories, or having larger inventories, or homeowners don't worry about inflation as much in the purchases of the houses and so on. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds, and so it's been fine to have. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So, for example, when there is the selling of bonds, it makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements and such things. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. And all of that becomes self-reinforcing. It's all happened before. It's all happened many, many times before. All currencies have a lot of debt. And so when you look at one relative to the other, there will be a lot of printing. I mean, currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. Now, will the dollar decline more than other currencies? It's almost certain that we're going to come into this environment. We're in this environment in which there's a shifting of those currencies. So you're going to see more of China's renminbi being used. You're seeing India have a direct link with Russia on the currency. So we're in an important change in the currency, but how that is a store of wealth is a different question. So a currency is a medium of exchange and a storehold of wealth. And its storehold of wealth is now a problem, particularly for the dollar, but it's also a problem for other countries. So that's why you have inflation. As money goes into other things, and the cost of borrowing is so low relative to the inflation rate, then it encourages the borrowing of money and the sale of money. In other words, not holding financial assets like that. So that's, yes, I think you're changing the nature of what money is. Right now, the US is imposing sanctions. Sanctions it's a form of economic warfare, and it has a big implication for the dollar, right? Mm-hmm. Okay, now others are trying to get out of the dollar system. There's a dollar system that now is being changed. India is dealing directly with Russia and holders of dollar-denominated assets. don't want to hold those dollar assets if they feel that they're going to be grabbed and so on. So what's happening now has happened many times before. And without that kind of perspective, I wouldn't be able to deal with it. And I learned this in my past because, well, just quickly, in 1971, I was clerking on the floor of the New York Stock Exchange. And President Nixon gets on and he says, we're not going to give you the gold that the dollar is backed by. And we had a devaluation. It took me by surprise. I walked on the floor of the stock exchange. I thought it was going to go down a lot. It went up a lot. And that's because I never experienced the currency devaluation. I found the same exact thing when I studied history, same exact announcement took place on March 5th, 1933 by Roosevelt and had the same effect. So I understood then how history before me was important. Studying the Great Depression allowed me and Bridgewater to anticipate the 2008 financial crisis. The past is a guide to what's happening now. And so when you spend a lot more money than you earn, then you have to print money to make up that difference, to make the purchases. And then that devalues money. And so it's like the examples I gave you of the two currency devaluations that you had before. 1971 led to the inflationary period of the 1970s. And so you have the stock market. Yes, the stock market goes up and other things, but cash is trash. And people then begin to learn that the bonds that they're holding have negative returns. And it starts to change the value of money. The value of money, the value of dollars and so on. So money goes into other assets. It produces more of an inflation and you start to enter a certain type of environment. And the environment that we're in is beginning to be very much like that of the 1970s.